Good evening, ladies and gentlemen. Welcome to our session titled ESG and Future of Sustainability in Saudi Arabia. And thank you very much for joining us today. We will be having an interesting discussion on one of the most pressing topics in modern finance and the corporate world at large, ESG. The subject is quite large and is expanding by the day as more issues, events unfold, and corporate practices evolve. And as the title suggests, our discussion revolves about the future of sustainability in Saudi Arabia. But first, please allow me to give you a brief background. A prominent pillar of the Saudi Vision 2030 was the Financial Sector Development Program that supports the development and advancement of the financial sector organizations. One of the most outstanding initiatives was the establishment of an academy to develop skills, knowledge, and expertise in the finance sector and subsectors. Launched in March 2019, the Financial Academy is an entity that provides training and development solutions to supply the financial sector professionals with the necessary knowledge and skills for both novice and experts. In the ESG context, the Academy is excited to introduce the Economic Growth Forum, the EGF, under which this event is taking place. This is a four-part webinar series that was prepared in collaboration with the CFA Institute. And in this context as well, the forum is in its sixth run today. So this was in collaboration with the CFA Institute and the CFA Society in Saudi Arabia. Today is the first webinar in the series, which aims to share knowledge between subject matter experts at a local and international level. Also, it discusses practical approaches to the ESG and offers localized solutions for the working professionals to think forward. We have two great speakers for today's session, coming from both the CFA Institute and the Saudi CFA Society. But first, I'd like to introduce myself. My name is Reem Asad. I have 15 years of experience in finance in different capacities, and I will be your moderator throughout the series of webinars. Of course, both speakers will be offering their views on the subject, followed by 30 minutes of Q&A time. So please allow me to introduce our first speaker from the CFA Institute, Mr. Rodri Priest. Mr. Priest is a senior head of research for the CFA Institute and is responsible for leading the organization's global research activities and publications, managing the research staff, and collaborating with leading investment practitioners and academics. Mr. Priest is also a current member of the PRI Academic Network Advisory Committee and a former member of the Group of Economic Advisors of the European Securities and Market Authority, ESMA, Committee on Economic and Market Analysis. He has a bachelor and an MSc in economics and is a CFA charter holder since 2006. We would like very much to welcome Mr. Priest today, and I will then give you the mic, Mr. Priest.
Thank you kindly, Reem, for the introduction, and thank you also to the Financial Academy for inviting me to present today's webinar on sustainability and to be part of this webinar series on ESG. CF Institute is truly grateful and appreciate the opportunity to collaborate with the Financial Academy on this important topic. So the focus of my remarks today will be on what I call the future of sustainability in investment management. This is based on a research study that we did by the same name just under 2 years ago. And here I will provide a global overview of the sustainable investing landscape, covering such issues as the demand for sustainable investing products and strategies from clients, from retail and institutional investors. And I'll also look at how is the investment industry responding to that demand from clients in terms of product development, how firms are adapting their business models and building out their teams to respond to that client demand. And I'll conclude with some actions that professionals and the industry can take to help advance the transition towards better integration of sustainable investing practices into the investment management process. So on to the next slide. And to start off, I wanted to outline these three kind of fundamental concepts. When we talk about sustainability in investing, there's three important tenets that we advance here. The first is that sustainability is additive to traditional investing. It does not mean a rejection of foundational concepts around how portfolios are managed when we think about risk and return. Sustainability is really an additional consideration that investors need to build into their foundational concepts and ideas around portfolio construction and investment management. Importantly, sustainability develops deeper insights around the creation of value, thinking about both financial and non-financial factors. And here, ESG considerations really form the tools of sustainability analysis. Environmental, social, and governance factors. Those are the more granular data points that help enrich the development of sustainability analysis and the building of portfolios that have sustainability incorporated into them. And then thirdly, sustainability considers investors' impacts on many stakeholders. So it takes a multi-stakeholder view of how value is created and generated. It's therefore much broader than the traditional financial capitalism model. It's much more consistent with what we would think of as a stakeholder capitalism model, where corporations realize and understand their responsibilities to not just their shareholders, but also to their employees, to their customers, and the wider society. On to the next slide, and here we outline the basis for the research that we've done to inform this work on the future of sustainability. We did a large-scale, actually two large-scale surveys, one of end investors, so both retail and institutional clients, encompassing over 3,500 retail investors and more than 900 institutional investors, such as pension funds, endowments, insurance companies, and others. And so that sort of gives the view in terms of demand from the end investor. From the practitioner standpoint, in terms of the professionals that are then managing the assets on behalf of clients, we surveyed the CFA Institute global membership. We had more than, well, actually nearly 3,000 responses from our members, including over 300 in roles, including Chief Investment Officer, Chief Executive Officer, and Chief Financial Officer. We then supplemented that with qualitative feedback from a series of roundtables conducted across 31 markets globally, and that allowed us to gain insights from more than 250 professionals, including ESG specialists, policymakers, academia, and other stakeholders. So on to the next slide, and here we summarize the four kind of key components of this overview of the sustainable investing landscape. The first is what we would call influences, so really looking at the demand from clients for sustainable investing. The second is drivers, so how are firms responding to that demand in terms of building out their products, adapting their business models, and so on. The third part is what we call the enablers. So looking at the operating model, how do firms think about the development of talent and skills to make sure that they have the right tools and capabilities to really create these sustainable investing products and meet that client demand. So our focus in this section, particularly on data and the issues around building sustainability skills and expertise. And then finally, action. So what does the industry need to do collectively to help embed these concepts and practices into the investment management industry? So let's start off and have a look at the influences section. So if we go forward to the next slide. And on to the next one. So here as a backdrop for the demand for sustainable investing, this slide just shows at a very high level the growth in the number of organizations that are signatories to the Principles for Responsible Investment, that's the PRI. We now have more than 3,000 organizations globally that are signatories to the Principles for Responsible Investment. These embed the UN sustainable development goals into their business models, and these signatories are required to report on their compliance with the principles to the PRI on an annual basis. So we now have more than 3,000 organizations that are signatories to the PRI, and in terms of the assets and the management of those organizations, they exceed 100 trillion US dollars. So a significant volume of assets that are now being managed in accordance with the principles of the PRI. The next slide shows you another data point, just really emphasizes the interest in the topic of ESG. It's never been more popular. This is a simple Google Trends search, which looks at the number of searches for the term ESG in Google. And you can see that this has been on a pretty sharp acceleration going back to around 2017, which is around about the time where the investment industry was really starting to, embrace the sustainability concept and start thinking about how do they cater to the need for or the demand for ESG investment products and strategies. On to the next slide. We asked our members, CFA Institute investment professionals, which of the following areas do you take into consideration in your investment analysis? And we see that there's been a significant increase compared to 2017, the proportion of professionals saying they take environmental factors into consideration. That's now at 70%. 2/3 say they take social factors into consideration, and almost 4/5 saying that governance factors form part of their investment analysis or decision making. So again, steady growth in a number of those factors, but really the biggest jump is in environmental factors, which are increasingly being incorporated into investment analysis by professionals. In terms of the motivations for why professionals are considering these ESG factors, it's firstly because professionals say that consideration of ESG factors helps them to better manage risks to the portfolio. That's largely consistent with 5 years ago, 2017. However, the second highest response category is that clients are demanding it. So we see roughly a 15 percentage point jump there in the proportion of respondents saying that clients or investors are demanding ESG factors be incorporated into their portfolios. So that really, again, underscores the strong demand for ESG and so on. On to the next slide. And now I'll turn to what we call the drivers part of the overview of sustainability, looking at how do firms respond to this demand from clients in terms of building out their business model and their investment processes. So this next slide will show you the business opportunity. And firstly, it's important to note that as firms embrace the opportunities brought about by sustainable investing, that to make this a reality, sustainability should be reflected in the governance surrounding the development of new products and strategies, including reporting and disclosures to clients, as well as incentives. So thinking about internal governance, remuneration structures, as well as fee structures in investment products. Those all need to factor in sustainability considerations for product development to be conducted and built out in a responsible way. In terms of product development, we see future growth opportunities to include more ESG index tracking funds or passive benchmarks that are cap-weighted benchmarks aligned to some sort of ESG index or index of companies that score relatively highly according to ESG criteria. We see growth in ESG quantitative funds, thematic products. So these include strategies where funds are focused on a particular ESG theme, such as green energy, clean water provision, and so on. ESG multi-asset products is another growth area. And then importantly, to enable the transition to net zero, we do see a lot of demand and therefore product development in climate transition strategies. And these are predicated on better benchmarks that allow firms to benchmark the carbon emissions of their portfolio and to figure out if those investments are consistent with a decarbonization agenda that would take the portfolio down to a net zero carbon position by 2050, or whatever the appropriate deadline is for that particular jurisdiction. The bottom of this slide just shows the interest in ESG among retail investors. So on the left-hand slide, just briefly, you see that less than 20% of retail investors are currently employing ESG strategies. But on the right-hand side, you can see that roughly more than 3/4 of investors say that they are interested in ESG strategies. And that interest amongst retail investors is higher amongst younger investors. So those in the 25 to 34 age range, we see more than 4/5 saying that they have interest in ESG strategies. And it's a similarly high proportion, above 3/4, for those aged between 35 and 44. And that interest tapers off a little bit as you work through the age ranges that we've examined in the study here. On to the next slide. And here we look at the motivations for end investors, both retail and institutional, for investing in ESG products and strategies. On the institutional side, 2/3 of investors, so that's the majority of respondents, say that they are interested in ESG strategies because they expect ESG investing to result in higher risk-adjusted returns. So there is clearly a perceived financial benefit from allocating investments in accordance with ESG strategies, or incorporating or integrating ESG analysis into the investment process is considered to yield improved risk-adjusted returns. On the retail side, we see that risk-adjusted returns is important, but the highest response category that we hear from retail investors is that they say 44% here in the bar chart, saying that they want to express personal values or invest in companies that have a positive impact on society or the environment. So there is that sort of non-financial, values-based motivation that we hear coming from retail investors as to why they're interested in ESG products and strategies. On to the next slide. In terms of the particular kind of ESG issues and themes that are motivating retail and institutional investors, on the left-hand side, we have the responses from retail investors, and you can see that it's by and large environmental factors that are motivating retail investor demand for sustainable investment strategies. Climate change and carbon emissions, clean energy, air and water pollution, those are the top 3 issues that are cited by retail investors as underlying or motivating their interest in ESG products and strategies. On the institutional side, it's more of a mixture across the E, the S, and the G. Data protection and data privacy was cited as the top reason amongst institutional investors, the top ESG concern, followed by sustainable supply chain management, and then again, climate change and carbon emissions. So clearly there's an alignment there between all types of investors around the climate transition and the challenges associated with that net zero transition. So climate change, carbon emissions continues to be a very prominent consideration for all types of investors. On to the next slide. And in terms of the approach of institutional investors to ESG investing, the right-hand bar chart illustrates the different methods by which ESG can be factored into the investment process, ranging from relative or best-in-class screening, where you are selecting companies within a particular sector or a particular industry grouping that score relatively highly according to ESG criteria. That also includes tilting the portfolio or overweighting your portfolio relative to a benchmark in companies that score highly on certain ESG characteristics. Those are some of the most popular approaches as of 2022 when we last conducted this survey question. Some of the less popular approaches are towards the bottom of the chart here. Engagement and active ownership actually stands out as the biggest change from 2020, where we see a marked reduction in the number of institutional investors saying that they are engaging with companies and conducting so-called stewardship activities, perhaps because of the high costs associated with that, and perhaps again with the preponderance of new data sources that other types of ESG approaches are are simpler to incorporate into investment analysis. On to the next slide. Here I will briefly review the enablers. So looking at the operating model, how are firms responding to the demand for ESG products by building out talent and skills, as well as thinking about the data sources that are needed to underpin sustainability analysis. And on to the next slide. Here we look at the commitment that firms have to ESG research. So, in brief terms, we see that, as of our most recent survey, 90% of respondents say that they expect their firms will have a greater commitment to ESG research in the next 5 to 10 years. The proportion saying that their firms' use of ESG research and commitment to sustainability issues will be significantly higher than today. It's actually at 55% as of 2020, and that's up more than double from when we asked the same question in 2018. So again, seeing that firms are very much focused on building ESG analysis into their research and their portfolio construction processes. In terms of data, the next slide talks about the different types of data sources that companies use. ESG ratings are somewhat important. On the right-hand side, you see that over half of respondents say that ESG ratings are one input into their investment analysis, but still a large number of respondents say that they don't rely on ratings currently. So I think that underscores the fact that there is no sort of universal approach to doing ESG analysis. Every firm has their own approach. Some of them rely on off-the-shelf solutions from data vendors to support their sustainability assessments. Others incorporate more proprietary information sources into their own in-house research. However, there is some concern over greenwashing. This is the concept that firms are brandishing their ESG credentials and labeling products as being sustainable, but when you sort of look under the hood, those products or strategies often don't live up to the stated commitment or aims in the marketing materials associated with those products. So there is some concern there amongst investors around greenwashing, and I think that underpins the need for the industry to take a fresh look at disclosure and standards, and make sure that product disclosure standards are ethical and client-centric and are faithful to the sustainable investing theme or strategy pursued in that particular product. On to the next. I will skip the next slide, actually. This is just in the interest of time. Let's go forward to the next slide, please. So here we look at skills. So thinking about the people model within the investment firm, we asked a question recently of CFA Institute members. Are you proficient in more than 14 different skills that we list on this slide here? Sustainability is in the second row. You see that only 9% of respondents say they are proficient in sustainability. So I think that's a good proxy for the supply of talent in sustainability. On the other hand, 70% say that they are currently pursuing training or are planning to pursue skill building in sustainability. So a high demand for developing skills in sustainability. And the gap between the supply of talent saying that they are proficient in sustainability and the demand for talent, those saying that they are looking to equip themselves with sustainability knowledge and skills, is very high, 61%. It's the highest skill gap amongst 14 different skill categories that we analyze. So again, that illustrates there is much really for the industry to do in terms of upskilling its talent pool and its workforce to be ready to meet the opportunities and challenges brought about by this transition towards greater incorporation of sustainability in the investment process. Let's go to the next slide, please. This just shows that there is no one-size-fits-all solution to building an ESG team. We asked organizations, do you employ a dedicated ESG analyst? Around about a third said they don't, because they require their portfolio managers to have a generalist skill set and knowledge of ESG issues. So they don't rely on ESG expertise per se, it's simply a requirement of all frontline investment professionals. Another third say, yes, they employ ESG specialists, and another third say they don't rely on ESG specialists, either because they outsource that capability or ESG is not part of the investment process. So I think this just really underscores the need that ESG expertise is not a one-size-fits-all solution. It depends on the size of the firm. It depends on the intensity of the ESG strategy being pursued. And firms need to think about how they build out their teams to get the right mix of both practitioners with generalist knowledge of ESG, as well as ESG subject matter experts, where sustainability strategies are a material component of the firm's business model. So with that, I think I will stop here and pause my presentation and hand back to you, Reem, so that we can hear from Kaushik, hopefully, and get a local market perspective from Saudi Arabia. So I will stop there and pass back to you. Thank you.
Thank you very much, Mr. Priest. Informative talk indeed. Lots and lots of questions have been emerging and jumping to mind. But as you said, we will be transitioning to the Q&A after our speaker from the Saudi CFA Society, Mr. Kaushik Chaudhry. Please allow me to introduce our second speaker for the day. He is the Executive Director and Head of Portfolio Management in the Saudi Fransi Capital Company. He is responsible for managing funds and discretionary portfolios in equity and fixed income, as well as formulating investment strategy and client management. He has 18 years of experience in the industry and has covered a wide-ranging roles in side equity research. He is also head of asset allocation and development of new products and strategies in Saudi Arabia and the GCC. Prior to joining Fransi Capital, in which I have worked one day, Mr. Kaushik was a fund manager with Bank Muscat, SAOG, and has previously worked with MetLife and ING Bank. He has an MBA in finance, a master's in economics, and of course is a CFA charter holder and holds the CFA ESG certification. Mr. Chaudhry, wow, welcome to the session. The floor is yours.
Thank you, Reem, and good evening, ladies and gentlemen. So Saudi Arabia has taken a multidimensional approach towards addressing climate change issues and incorporating the global best practices for ESG and sustainability in line with the Vision 2030 program. It broadly consists of initiatives to implement energy-efficient programs, develop carbon capture technology, increasing public transportation, increasing the renewable energy capacity, and also increasing Saudiization, and in particular, female employment. In the session today, we will discuss some of these key initiatives in these areas and also cover some of the issues and challenges with respect to the ESG-related disclosures and investment products in Saudi Arabia. So the roadmap towards sustainability was laid some time back by His Royal Highness Crown Prince Mohammed bin Salman. Saudi Arabia has been a signatory to the Paris Agreement and the Kyoto Protocol and pledged to be net zero by 2060 to reduce 278 MTA of carbon emission by 2030, and also joining the global methane pledge to cut emission by 30%. We have been seeing tangible and measurable progress in all these areas already. The country has launched several giga projects as part of the Vision 2030 program. Renewable energy and fighting climate change is at the core of this initiative. To highlight a few key developments in this regard, Enoma, which is the subsidiary of NEOM, it plans to build a desalination plant powered by 100% renewable energy in Oxagon. The desalination plant with a 500,000 cubic meters per day capacity will meet approximately 30% of NEOM's forecasted total water demand when it is completed in 2025. Similarly, a $5 billion world-scale green hydrogen-based ammonia production facility, again powered by renewable energy, is being set up, and it will produce green ammonia, which is actually earmarked for exports going forward. Saudi Arabia has also pioneered the Middle East Green Initiative. in which approximately 40 billion trees will get planted in the wider GCC region, and out of which around 10 billion trees is the share of Saudi Arabia alone. It is now touted as one of the largest reforestation programs in the world. By 2030, the plan is to rehabilitate approximately 8 million hectares of degraded land and reduce approximately 200 million tons of carbon emission, as well as increase the green cover from the current, I believe it's about 1.5% to around 9%. A voluntary carbon exchange platform is now expected to be launched soon. Now, this is a great initiative by the Sovereign Wealth Fund, the PIF. And as and when it comes to reality, it will be a great platform for carbon offsets and credits in the MENA region. So what we know is that companies like Aramco, Saudi mining company Ma'aden, Aqua Power, Inawa have already signed agreements with PIF. Rapid progress is being made even in the energy efficiency programs. This includes implementation of new energy efficiency standards in power generation, water desalination, electricity transmission and distribution, as well as technology to capture carbon emission and produce chemicals and other synthetic fuels. A push towards gender equality and sensitivity and increase in female employment is also an important element of Vision 2030. Saudiization, generating local employment, and incorporating local component in tendering through the ICV process is also being implemented across various industries. With this sort of a macro background, I will now briefly touch upon a few initiatives and programs which are currently underway by some of the large corporates in Saudi Arabia. So starting with Saudi Aramco, one of the world's biggest oil producer, it started a comprehensive sustainability reporting since 2021. The company plans to achieve net zero, both on scope 1 and scope 2 greenhouse gas emissions by 2050. And this gels well with the kingdom's aim to reach net zero by 2060. The other key initiatives from Aramco include the zero routine flaring program, which I believe currently in 2021, it is about 5.51 SCF/BOE, and aiming for a zero methane emission intensity by 2030 from the current level of 0.05%. The company also has plans to reduce upstream carbon intensity by at least 15% by 2035. Now, we must note that all these targets, they account for the anticipated increase in oil and gas production as well. So Aramco also plans to have almost 12 gigawatts of renewable energy by 2030, which is in support to the National Renewable Program. Moving to Saudi mining company, Ma'aden, the sustainability reports are being published, I believe, since 2019, and they comply with the GRI standards of reporting. They have put extremely measurable goals and targets for 2040, 2030, and even 2060 in some cases. If I may highlight a couple of initiatives. So for Ma'aden, the scope 1 and scope 2 GHG emissions intensity reduction, the target is to reduce it by 37% in 2030 and by 60% in 2040. Groundwater usage, again, reduction by 46% by 2030, 65% by 2040. Renewable energy usage, so in terms of their total energy mix, they intend to have around 10% of the energy mix in renewables by 2030 and 20% by 2040. Now, as far as the Saudi mining company is concerned, there is also another very interesting initiative. There has been a very aggressive push by Ma'aden to localize the production and use local content in the entire supply chain for the company. So even now, more than 50% of the procurement-related spending has been earmarked for local content, and an estimated 25,000 plus jobs has been created in the country itself as I speak now. Moving to Saudi Electricity, which is obviously one of the largest utility players in the entire region. By the year 2030, Saudi Arabia plans to have 50% of its electricity generated from renewable energy sources. And as you can imagine, Saudi Electricity is very much at the core of this initiative. So to promote the integration of renewable energy and to reduce the generation of greenhouse gases, Saudi Electricity SECO has committed to investing almost $3 billion into 25 specific renewable energy projects by the year 2026. So this is expected to ultimately result in avoidance of almost 33.5 megatons of carbon dioxide equivalent emissions per year going forward. Now, one of the highlights for Saudi Electricity is related to their smart meter project. This was valued at almost, I think, $2.5 billion. And what they did was they basically went and successfully implemented over 10.5 million smart meters throughout Saudi Arabia. Now, I will again come back to this and talk about it a little later when I talk about the green bond issuance, the green sukuk issuance by Saudi Electricity. This was specifically to fund this project. Saudi Electricity also is a very key participant in the National Renewable Energy Program and aims to develop 6 renewable energy projects in the country with a total volume of 2.6 gigawatts of power. Now, I will now turn my attention to some of the company reporting and disclosure issues related to ESG, as I see in Saudi Arabia. The local Saudi equity market, the exchange, the Tadawul, has already published certain guidelines aimed at improved disclosures from the listed companies on ESG. And we do expect more and more companies to come out and report this ESG-related issues facing their company. So if I look at it from this perspective, out of the 3 pillars, E, S, and G, in my view, the G pillar is probably the least challenging. And the reason is that as part of their annual reporting, all the companies at the moment, they do report significantly on corporate governance related issues. For example, board composition, the remuneration committee, the nomination committee, representation of female in board and in the senior management. These issues are already being reported by most of the corporates. In my view, even certain elements of E and S, the other 2 pillars, are also being reported. For example, a lot of industrial companies report quite extensively on HSE issues, health and safety related issues, quality control issues in manufacturing. Almost all companies report on labor practices, details on Saudiization, corporate governance standards, and so on and so forth. A lot of companies report on the CSR practice, the corporate social responsibility practice, which they have. Now, I think the only challenge that we face is there need to be a sort of a unified approach in which all these different elements of ESG are kind of taken together and disclosed in a sort of a unified template. I think that is something that the industry needs to work on. See, from a global manager's perspective who are looking at the Saudi market, if you look at the Bloomberg ESG risk disclosure score, approximately 36 of the 212 listed companies in the main market have a score in the first place. Now, this obviously is still very low, in my opinion. But once you have a sort of a unified approach and unified template to report all these issues related to ESG in one place, I think there will be a significant increase in the numbers and also the quality of disclosures going forward. I will now move into some of the other issues and challenges, particularly related to the investment products in Saudi Arabia. To start with, the green bond issuances and sukuk issuances has been a relatively new area of development in the region. Currently, as I speak, if you look at the capital markets and if you look at the total sustainability and green sukuk and bonds, which are currently in the market, approximately $6.4 billion is the issuance size for the region as a whole in the GCC, which is perhaps a very small number compared to the global issuances in this category. But nevertheless, I think it's a good start. For Saudi Arabia, when you talk about the green sukuks, Saudi Electricity had issued green sukuks amounting to $1.3 billion in September 2020. And in fact, I did talk about the smart meter project earlier. This was done to facilitate funding of that particular project. So they follow the ICMA green bond principles and also use a harmonized framework for impact reporting. So just to repeat that, an estimated 10.4 million smart meters were installed, and it resulted in an avoidance of approximately 1 million tons CO2 equivalent emission and energy savings of approximately 1.5 million megawatt hour. And bear in mind that the benefit actually accrued to almost 34 million people. So looking at the overall landscape, the fact that there are so many giga projects which are currently being executed, one gets the impression that we might see a lot more green bond and green sukuk issuance in the coming period of time. With regards to banks, Saudi National Bank, Riyadh Bank, they have also been quite active in this area. So Saudi National Bank published the Sustainable Finance Framework in December 2021. The core thesis is the same, essentially exposure or loans to finance eligible projects which qualify under the framework, like renewable energy or other sustainable projects. Now, there is one interesting facet to this. I think the green bonds and sukuks will attract dedicated investment funds, even global managers who are investing into this particular theme. And I would believe that this will eventually provide better liquidity, in my opinion. So we would like to see a lot more developments as far as green sukuk issuances are concerned in Saudi Arabia. Moving on to the last part, which is related to equity funds and benchmark. This potentially is a very, very sort of a nascent area of development. I think the benchmarks are commercially available. Some of the vendors are doing a lot of work in this area. Now, the challenge for having an equity benchmark is inevitably tied to the issue of disclosure, and specifically standardized disclosure. Look, at any given point of time, if you wish to define a universe of stocks related to the ESG theme, and if you go by the Bloomberg risk disclosure score, you will probably end up having 20, 25 names in a sort of a notional universe. So that would make the benchmark, I would imagine, slightly concentrated in nature. However, if you model for all other disclosures that are currently available, then most probably your universe size will become bigger and it will become more representative of the market. Now, as an asset manager, this is something which we are looking at very closely. I think there is a lot of appetite and demand for ESG-related investment products in Saudi Arabia. And if you look at the green bond issuances that I was speaking about, there has been a substantial oversubscription in these issuances when it came to the market. So to conclude, the initiatives in Saudi Arabia, what we have seen is by and large top-driven at the moment. I think the Vision 2030 program of the government, then the large corporates taking a lead in developing the ESG practices. So we are in for very exciting times, and I do believe that as disclosures improve, more benchmarks are created, there will potentially be a very strong appetite from large asset owners and asset managers as well to bring out more ESG-related products in Saudi Arabia. So thanks for listening in, and I would now hand it back to Reem to open the floor for further discussion and Q&A. Thank you so much.
And thank you very much, Mr. Chaudhry. Insightful ideas indeed. So both gentlemen, for further insight, I do have some questions for you. We'd like to move to a discussion on your views and opinions. I have frankly prepared some questions, but you both have covered some of the answers in your both in your presentation and your talking points. I would like to ask those questions, not specifically to any particular one of you, but I know that both of you have views and have experiences in that. So I will start by, I'll pick up from the Saudi Vision 2030, since this is the scope of our discussion here. The Saudi vision, as we know it, is very much geared towards sustainability, and that has been evident and clear in all the literature and all the media that the observer has seen. So in all areas, in the E, in the S, and in the G, it is clearly a top-down push to enter this realm and incorporate those standards into the corporate practice. Now, on the other hand, and this is more of a Saudi question, on the other hand, given that the Saudi equity market is still highly retail HNW, high net worth dominated, many investors may not be especially consider ESG compliance in building their portfolios. So I guess the question would be that, can the private and the public sector together cultivate an ESG awareness or aware culture or investor base? And maybe the same question to Mr. Priest from your experience in other emerging markets.
Sure. If I go in first, look, I think there is definitely a strong sense of understanding and awareness. I think the first point is about awareness. A short answer to this is that market participants, whether it is retail or whether it is institutional investors, there is a very strong awareness regarding ESG. Now, like I mentioned before, I think as far as the retail clients are concerned, if I touch upon that particular segment of the market, there is definitely a level of curiosity. That's the way I would characterize it. I think when you talk to retail clients, there is a bit of curiosity around the whole concept. But at the same time, for retail clients, I think it is about whether a certain product is available or not. And when I talk about product, when I talk about a fund, when I talk about portfolios, I think it is inevitably linked with the disclosure issues that I spoke about earlier. So I think this is an ongoing area of development, in my opinion. Now, I think the biggest push and the biggest sort of support would probably come from the large institutional investors and the large asset owners. I mean, as you mentioned, that since this is very much a sort of a top-down approach that we are seeing, I think it is probably the institutions which will, or the large asset owners or asset managers like us, who will probably take the lead, and they're already taking the lead, and followed by a more general interest by retail investors. So this is what I see in the market today.
And
Mr. Fries, from a more emerging markets perspective, global perspective.
Thank you, Reem. So maybe I can just start off and refer back to some of the data in my slide where we looked at the level of interest among retail investors in ESG products and strategies. And in terms of the proportion of retail investors that are currently invested in ESG themed products and strategies, is actually pretty low, as I think my slides were showing there. Less than 15% generally across different age groups of retail investors saying that they are currently invested in ESG. When you break the same data points down by assets under management, or let's say wealth levels, you see a skew that it's certainly investors amongst the higher net worth categories that are currently more active in allocating money to ESG strategies. But again, from a relatively low level, if you look at overall, you have less than 15% globally across the markets we've examined as saying that they are invested in ESG. However, there is high demand. So to support the points that Kaushik was making there, certainly a lot of interest. Again, the survey data that I shared earlier showed that more than 3/4 of investors globally across the different age groups that we analyze say that they are interested in ESG products and strategies. To answer your question, what can be done and what are some of the lessons learned in other emerging markets? Certainly more investor education and information being made available by national authorities, stock exchanges is an important part of that. There are a number of exchanges in emerging markets that are investing in ESG education hubs, providing repositories of research and information on ESG products and ideas and concepts, so that interested investors can learn more about the concept of ESG investing and what products are available to them in that local market, whether it's an exchange traded fund or some other open-ended fund where they can invest their money in. So I think there is a an investor education and a financial literacy component, and the exchanges can play an important part in that. The other comment I would make is that we've seen and heard in the remarks today that environmental issues are the considerations that are top of mind for retail investors when they think about ESG, and the transition to net zero is going to take place at different speeds across different markets. I think that's important to recognize. Clearly, as we've heard from Kaushik, a lot of great work is being done in Saudi Arabia with the Vision 2030 and so on. But if I look in some emerging markets in Asia Pacific, there is still a very heavy reliance on traditional fossil fuel industries without necessarily a government-backed plan to facilitate that transition. And I think it's just fair to say that it depends on the local market circumstance. We have to also think about the just transition. So when we make this move to net zero, there will be costs associated with that, and those costs will be borne disproportionately across different markets and societies. And governments need to factor those considerations into their thinking when they look to advance the sustainable agenda. So there are costs as well as opportunities here, and the local market specifics should be taken into account when we're thinking about how do we enable investors to allocate to these products, and what are the associated capital flows that will fall out of those types of investment approaches.
Clearly, I mean, this is a tripod, the E, the S, and the G. I saw that from experience and having worked firsthand with an ESG initiative in the financial industry. Clearly, in the financial industry, there is more emphasis on the S and the governance element of this formula. And it turns out that governance has been, especially in the financial industry, is probably scoring highest. Social is largely on the way. The finance industry has employed women. The equality in terms of wages, the gap wage is not something that is wide in this part of the world. I mean, a lot of women I haven't seen too many women complain of the wage gap and so on. But then can we think of this as something that is sector dependent? So if we're talking about net zero in 2016, that's highly environmental. So would that confine the ESG practice more, or make it more geared into the industrial sector at large? Or are we talking across the board? I know obviously and scientifically it goes across the board, but conceptually speaking, if we would like to raise awareness, would we be talking science and environment? The question is for both of you, gentlemen.
If I could quickly respond to that, I think it does depend. It is industry specific in terms of which of these issues, the E, the S, and the G, are most material. The Sustainability Accounting Standards Board, the SASB, had done some really good work to lay out what it calls a materiality map to help investors understand which criteria are most financially material to their investments, depending on what industry or sector a particular company falls into. So, I think that the short answer is it depends. It's context specific. But there is a role there for standard setters and investor organizations to help professionals understand the materiality of these components when they're factoring in ESG considerations into their portfolio. So we've spoken a lot about environmental issues, and clearly that's a huge challenge in in a number of sectors, whether it's construction as well as energy supply generally. But those issues are generally not true in, let's say, the financial sector. So there you have to look at the materiality of other issues, and corporate governance is more of a, let's say, a universal issue across sectors. I think there is a lot of theory and established practice that governance, good corporate governance is important to protect shareholders' interests, and in the long run can improve corporate valuation. That is a well-established concept. Corporate governance standards vary across markets. Again, they're set by local supervisory agencies, financial reporting bodies, as well as the local stock exchanges. But the importance of governance is let's say, ever present across whichever industry or market you look at. But in terms of the E and the S factors, I think, again, the materiality of those issues is much more industry or sector specific. And that's something that your professionals are having to contend with and to factor into their analysis so that they can make well-informed judgments as they integrate these issues into their investment analysis.
Yeah, I think for me, I would probably add a couple of points here. I think, yes, it is sector specific. And now what is also important is to understand that there is also a sort of a local context to what you disclose and how you disclose. And I would assume that there are certain local considerations which are also, it gets built into your KPIs, essentially. Now, for example, it was interesting, like, you talk about a green loan from a bank or a green bond or sukuk issuance. Now, when you talk about a financial institution, I think somewhere the environmental factor becomes less of a priority, if I may put it that way. But globally, banks do report on their physical assets, and in terms of emission, in terms of standards, the water usage, the leakage in any of their facilities, and so on and so forth. So I think, as I mentioned before in the talk, that a unified reporting approach would probably help. So in which the KPIs would possibly remain by and large the same. But what will happen is, depending on the sector in which you are operating on, certain factors will have a higher weightage for a particular sector or a particular company, whereas certain other factors might have a lower weightage, in another sector. So it's a degree to which the things might vary, in my opinion. But by and large, I think most of the ESG factors should be a part of the unified reporting, as long as we have it in a sort of a template. And it will be good for the industry, particularly in Saudi Arabia, because the perception is, unfortunately, in my opinion, for a lot of global managers, that not enough is being done in Saudi Arabia. We have just made a start. So I think, if you have a unified approach, if you come out with more and more disclosures with the work that we are doing here, definitely we'll see a much better sort of visibility of ESG in Saudi Arabia.
I think I'd like to touch upon something that you have just said, and I read that on Twitter. So two things. I received one of the questions on DM on green sukuk. So some of the more novice followers would like to know about a little bit more about the green sukuk. The other question is about the fact that we are still, this is a story in the making, right? And yes, it is sector and industry specific, So can we draw comparison across sectors, or it'd be completely unfair? Because in this case, the E and the S and the G would not be held equally material across all industries. So let's just go delve into the sukuk definition first.
Yeah, sure. So, green sukuk or a green bond, by definition, is essentially the issuer, which is issuing the particular sukuk or the bond. The difference with the other bonds are that essentially this goes to fund certain projects which they consider as green. So if I may take the example of the existing sukuk that we have from Saudi Electricity, when it was launched back in 2020, it was basically to fund certain very, very specific projects. The smart meter project was a good example of that. So you know that when you are investing in the sukuk, it is not for general corporate purposes, but it is for a very specific project which will qualify under their, under their factors for a particular project which is considered to be good for sustainability or green finance. So essentially, this is what it is. Now, in terms of the green loans, for example, which a bank might provide, again, the core thesis remains the same. So essentially, we're talking of a loan or an exposure to a certain project or a certain certain exposure wherein you are funding a very, very specific project which is akin to sustainability. So you are not going to use the proceeds of that sukuk, or you are not going to use the loan for something else, right? So this is the overall concept. So there are some ICMA green bond principles which are available globally, and the banks follow that. Even some of the issuers are following it. There are some standard clauses over there, and the banks, when they establish their credit committee or their ESG committees, so they also what they do is they basically identify some of these projects or some of the areas where they seek to finance. So this is essentially what the concept is. Now, one question can come up that from an issuer perspective or from an investor perspective, how does a green bond or a green sukuk differ from another bond or sukuk by the same issuer? Now, there is a sort of it's a matter of some sort of academic debate. Globally, what we have seen, and Mr. Rodri can also add to that, there is a debate over that sometimes the green bond issuers, they enjoy a bit of a premium. I would not like to go into that academic debate now, but all that I can say is that given the nature of the sukuk, which is a green bond sukuk, it is likely that in future, some of the ESG dedicated funds, global funds, might be attracted to these issues, right? So it is entirely possible that compared to a regular sukuk or a bond, it is possible that liquidity might be better. It's possible. And also in certain cases, the issuer might enjoy, for example, a slightly lower yield. Now, again, I say that this is a sort of an academic debate, whether there is a genuine premium attached to it because you are green, quote unquote, that we have to see. But I do believe that for a lot of issuers in the region and in Saudi Arabia, what the future holds is that they would like to attract a widely diversified client base. And I see this happening in the years to come.
Yeah, thank you so much for shedding light on that, which takes me to the second point. Can science, and this question is for Mr. Priest, can science or evidence-based information help build investor awareness and momentum? For example, we would draw a conclusion from companies that are ESG compliant and have high scores on the material on their and have a high ESG score. And those companies have been, in terms of stock performance, have been performing better than companies that are not exactly compliant or not ESG following. those standards. So what do you think in terms of that? Is that a compelling story, or is it just another push in that direction that is made up to build momentum?
Yeah, I mean that's an interesting point. I think we have to be careful here, and firms, when they brandish their ESG credentials, also need to be careful not to fall into the trap of so-called greenwashing. That you say that you are complying with best practices, whether it's to do with your social policies or your environmental policies, and therefore this will make the company more valuable in the long run. Hard to know. I think the evidence from academic research doesn't really lead you to that conclusion that companies that embrace certain ESG criteria will necessarily deliver sustainable outperformance in the long term. I think the best thing we can say from a performance standpoint is that companies that are incorporating sustainability issues into their business models, into their governance practices, in terms of how they manage employee relations or issues in their supply chain, those companies are going to be more resilient and less likely to be exposed to downside risks. So there is certainly a risk mitigation benefit from incorporating these broader sort of societal and stakeholder issues into your business model. Simply put, in the current environment, if you're ignoring physical and transition risks associated with your assets as a company executive, or if you're not considering the treatment of your workers in your supply chain, you're really exposing your business to some pretty significant risks, and that could negatively detract on the share price. So there is a risk mitigation component to this that is important, but I think that is a separate point and discussion from saying that a company that scores well on ESG will deliver better returns in the long term, because there are just too many factors that will ultimately influence the return. It depends on the time you entered or exited the investment. It depends on the macroeconomic environment. So that the research there is much more mixed. And again, it's because of all of these other factors. But there is a clear argument to say that this can help improve risk mitigation and maybe reduce the downside risk in portfolios if you're factoring in these ESG considerations into your analysis.
Yeah, well, it's certainly a story in the making, and we're yet to see. I mean, there hasn't been so many decades to help prove scientifically what impact ESG has on companies' performance over the long term. But it is good. I think, yes, there is definitely an argument. So let's just shift a little bit to the area of ESG implementation, which forms challenges to companies that wish to adopt ESG standards or follow those. So undoubtedly, this may be one of the most challenges, and at least 70% of the firms and to at least 70% of the firms and entities across regions, across the globe. So what are the views on data? How can the data be easily collected, measured, to create meaningful cases of successful ESG investing? Because at the end of the day, an investor wants results. And I know, although ESG is still, the whole ESG story is still in the making, but do you think that composing, collecting, extrapolating the right set of data and following measurement standards can help us get there quicker?
I'm happy to respond to that quickly. I mean, I think this is really the crucial issue. When you think about enabling sustainable investing practices, it's all predicated on having good quality data to inform analysis and decision making. And here we've seen quite a lot of improvements in the quality of disclosures that companies are making in corporate reporting. Mr. Kaushik spoke to a number of those issues, some of the disclosures that companies are making around board composition, representation of women in senior management positions, ethical labor practices, and so on. So we've seen definitely an increase in the quality and the volume of disclosures on these issues, but there's more to be done there to sort of help create more consistency so that investors can really compare the quality of disclosures from one company to another or across markets. And that's a big body of work that is now being taken forward by the International Accounting Standards Board. It's in the process of setting up this International Sustainability Standards Board that is tasked with generating, a consistent set of financial reporting disclosure standards around ESG and sustainability metrics. So there's been some good work done to date for sure, and disclosures are improving, but there's more to be done there in terms of standardization, consistency, and comparability across markets. The other point to note is that financial reporting data is by its very construct backward looking. So it doesn't give you a complete picture of a company's sustainability profile at a given moment in time. I think there is, a number of vendors that are looking to provide additional data points, whether it's ESG ratings analysis or other alternative sources of data that can be fed in and used in the investment process. And it will play an important role in giving a more complete sustainability analysis. So, it's important to note that financial reporting disclosure is important, but by no means they are not the full picture here. And we have to look at the information needs of investors across the value chain, and really to support and enable data providers and others to make available the information sources that investors need to make the decisions in sustainability analysis.
If I may add one point here, Reem, look, I think most of the disclosures that are happening today, they are essentially voluntary in nature. And, it's essentially like it's a sort of an advisory that, look, if you disclose on ESG, it's good. Now, in a framework in which the disclosures are essentially voluntary in nature, apart from the very large corporates, when you go down in terms of the mid-cap companies or smaller companies, do they really feel the need to go through the wheel and disclose ESG related issues? Because again, it's voluntary, right? So I think
Yes.
the way I look at it is there has to be an element of enforceability, I think probably from the regulators, like let's say the local stock exchange, for example. I'm not saying that compulsory reporting, that probably would be a too harsh a sentence or a word to use. But I think what needs to happen is, even for the companies which are listed in the market, if that is the starting point, they will have to understand the benefits of these disclosures. And today, as things stand, Saudi Arabia is now a part of the MSCI index. It is an emerging market. The market depth is increasing. The market size is increasing. There's a lot of investor attention, particularly from global fund managers. And from my experience, what I have seen is, I think globally, if you talk to fund managers, I'm sure they are very well aware and they cover the large companies very, very closely already. That's happening. But when it comes to, let's say, companies which are probably a little lower than the top 10 or top 15 in terms of size, I think that's where the real benefit lies, because once the companies also realize that there's a lot of focus from the global investment community, and essentially if you are disclosing more, if you are giving the data, if you're complying with, let's say, the GRI standards as an example, then you can attract a more diversified clientele or an investor base, to whatever issuances you have. So I think it's perhaps a bit of a chicken and egg situation at the moment, but I think over a period of time, I really hope that the disclosures will improve. And like I mentioned before, a certain amount of reporting is probably already being done in silos. Certain elements are already being reported, but it's just that if you ask around, probably the companies themselves are not very sure in some cases that what needs to be reported and what needs to be ignored. So it's there we stand at the moment, but I genuinely hope, and I see that happening already, a certain element of enforceability from let's say, the local regulators would certainly help.
Yeah, one of the other things that I heard from one of the CEOs that I was speaking to in terms within the ESG conversation, one of the things that he was worried about, he managed a fairly large organization, and he said that I cannot work on this alone, although this could be a top-down kind of initiative, but I still want everyone across the board, across the organization, from the top people to the bottom of the pyramid, to understand why we're doing that, because there will be costs involved, there will be changes, there will be implications on various levels. So I think one of the things is that you really need to raise awareness, not just within the investing community, but within the organization itself, because that will eventually cascade down to layers and layers of the social sphere itself. I mean, after all, we're all employees and investors in the same time. So shifting from implementation slightly to benchmarks, I would like to know what is the latest on this matter in terms of benchmarking against global standards? Are we looking at regional standards or even local standards? Do we have something on that? Maybe both of you gentlemen can enlighten us.
Yeah, sure. Go ahead, please, Mr. Rodri, please.
Yeah. Thank you. No, I was just going to, I guess, refer back to my previous comment there, but just there is work being done at the international level. I think up to this point, we have had a patchwork of approaches in different markets, and again, to aid that international consistency and comparability, there is the need for harmonization of disclosure standards. Certainly around things that are kind of well established, that in terms of the information needs of investors around environmental issues. So, carbon emissions, scope 1, scope 2, scope 3 disclosures. How are they being measured? Scenario analysis. How is that being conducted and reported in financial reports? And then, of course, on a range of corporate governance issues. Here I think there is established best practices, although practices do vary across markets, but there is, I think, it's well established that disclosures around executive compensation, remuneration committees, CEO pay, and so on, that these issues are covered in the compensation discussion and analysis and other elements of the corporate report related to corporate governance issues. So I think there, again, practices vary, but there is some coalition around what are best practices on governance disclosures. Social issues do vary, I think, a lot. Again, it's somewhat dependent on the national or the regional context. So we don't have consistency there in terms of disclosure standards right now. Regulators in some markets are looking to improve the quality of disclosures outside of financial reporting that I've mentioned. There is work being done in China, in the European Union, around creating so-called taxonomies to really define what is a green activity or what is a sustainable economic activity, so that investors can think about these issues when they're building portfolios and use the taxonomy as a way to support their decision making. And the European Union has sort of gone a step further and has designed low carbon benchmarks to allow investors to build portfolios that have carbon emissions that comply with the EU net zero carbon transition plan. So I think that's an interesting area, an area for growth as well. As investors build portfolios, they want to build they want to build index exposure or build portfolios around benchmarks that are consistent with a certain carbon budget or a decarbonization plan. And that's frankly an area for product development in the industry. But as I said, it is being supported in some jurisdictions by the work of regulators as well. So that's a pretty broad answer, but lots happening around, as I said, reporting standards and the development of benchmarks.
See, I think for me,
yeah. Please go ahead.
Yeah, for me, I think very little to add, but it's still a very nascent area of development when it comes to benchmarks and things like that. Look, I think the fact that the local exchange, the DAOL, has come out with the disclosure document in the first place is, I think, a great start. So we now have a document in which certain expectations are already there. So I think compliance to that is certainly going to improve. And if you look at the larger corporates, and some of them I had covered during the discussion, if you look at the sustainability reports, they're extremely well prepared, and the disclosure levels are extremely high. And I would say they are amongst probably the best that you get, right? But this is probably true for the larger corporates at the moment. So I think it's a matter of time, in my opinion. But over the next year or so, or a couple of years, as this becomes a sort of more mainstream, I think companies would start, you might see sustainability reports from across the board and across industries in Saudi Arabia. So it will probably take some time, but I think we'll get there in due course of time.
Thank you, Mr. Chaudhry. Thank you, Mr. Priest. We are coming to the end of this webinar. I guess, as you both said, this is an ever-evolving story in which we are at the beginning. And it is exciting. It is loaded with challenges, with lessons to be learned. I wish to thank our guests today, ladies and gentlemen, Mr. Roderick Priest from the CFA Institute, Mr. Kaushik Chaudhry from the Saudi Fransi Capital Company, for joining us today and sharing some very valuable insights. We look forward to a new webinar, new angles on the ESG topic with the Financial Academy. Till then, I wish you all a very good evening.
Thank you.